thought leaders in the country. He has been a key figure in the Indian economic reforms process on a continuous basis from the mid 1980s, and it could not be more appropriate to have you talk on this important session, sir. Welcome, and over to you.
Thank you very much. I think you've described my lecture as the future of financial services. That's a very broad ranging definition. I view it as kind of looking a little bit ahead, but with the background of having been associated with this summit in earlier years. As I recall, I think the inclusive finance item has been on the financial agenda since about 2004, when the Inclusive Finance Summit idea was first launched. And I had the honor of participating in the summit way back in 2009. Now, I cannot help reflecting what a different world it was then in 2009 compared to what we see now, 12 years later. I mean, in 2009, the basic concern was that, look, we have a banking system, but not everybody has access to it. So the focus was we must get the banking system to, so to speak, serve the underserved. There was a presumption that the banking system itself is doing a reasonably good job, and it will expand, but it will carry on doing what it's doing. However, it's missing out, particularly the poor don't have access to it. I mean, huge numbers of people didn't have a bank account. So in those days, one of the implications of inclusive finance was to get people to have a bank account. But we also realized that having a bank account didn't mean you were going to get credit. I mean, you could have a bank account, but the banks would be extremely reluctant to give you credit, quite apart from the fact that they didn't really find it very profitable to open bank accounts because the cost of servicing individual accounts was very high. But nevertheless, the approach was that this will change over time, and we should widen the access to the banking system for people in India. And at that time, we, in fact, to look back, that is really well before the digital revolution, which has made modern banking so different, actually began. I mean, it was in 2009 that, Nandan Nilekani for the first time was actually brought into the Planning Commission in order to completely take over the setting up of the Aadhaar system. So that's how far back. I mean, there was no Aadhaar. The only thing we had was that Nandan had come in and said, I'm going to set it up. So very, very different time when I last addressed this summit. Now, since then, we've had a virtual revolution. I mean, not only is Aadhaar there and covers, 1.2 billion people or something like that, you had a revolution in technology. Mobile phone penetration has increased hugely. About half of them are smartphones with access to the internet, which of course gives them a huge potential to engage in all kinds of banking transactions. And this has practically revolutionized the banking system. So the problem of inclusion remains, but it becomes more complicated. I mean, earlier, the difficulty was that banks really weren't either, they didn't feel that they were really positioned well in order to deal with small clients. So the government approach in those days was, one is to bring people into the banking system and encourage banks to lend to them directly. But even then it was realized that really the important thing is for the banks to support self-help groups, and those groups would then ensure that access to credit goes to members. And then over time, the microfinance revolution began, and we had a huge growth in microfinance institutions, ran into problems initially, and those got taken care of. But that was the idea, that there's microfinance, there's self-help groups, and there's the effort to push the banks to do direct lending. What has happened since then? Of course, and this is not just in India, it's all over the world. The very nature of banking has changed with the growth of digital technology. And with digital technology have come two other things. I mean, one is not directly connected with digital technology, it's really non-bank financial companies. They were there before, but they've expanded quite a bit. They're much less, they're regulated, but they're much less regulated than the banks, commercial banks. And they occupied a space in lending. Then you had a technology revolution with the fintechs coming in, and the fintechs growing into what I believe are called neobanks. I mean, they provide a sort of platform that provides an interface between the balance sheet of a bank or a non-bank finance corporation and the ultimate borrower, and they leverage the huge potential they have for exploiting the information that's now available about individuals, which can be garnered through the credits India stack and all that, so that a lot more information is available about the potential credit worthiness of people who otherwise would not be able to establish credit worthiness. So this is another dimension in which change has occurred. And this is also financial inclusion. It's not financial inclusion looking at the needs of the poor. It's actually looking at all kinds of new needs, not just of the poor, of younger people, younger consumers, women, which now have a much wider access to financial services. They provide people ways of accessing not just bank lending and bank deposit services, but also things like insurance and mutual funds and you name it. So it's really a complete rewriting of what is now possible in the world of the financial system for ordinary individuals. You know, in this respect, it has to be said that we are moving much faster in the last, let us say, 20 years or so, much faster in this dimension than we did in the normal banking system. I mean, the normal banking, by the time the economic reforms began in 1991, I mean, India's banking system was behind the curve on many, many areas, including regulation. Looking at things now, when it comes to digital banking, we're not behind the curve. In fact, in certain things, like, for example, the Unified Payments Interface, UPI, we're actually ahead of the curve because such a system doesn't exist in the United States, but it exists in India. And I've seen submissions being made to the Senate committees, etc., that maybe the United States should have something like the UPI, which would actually make it much easier for banking transactions to take place on a real-time, not office hours, but 24/7 kind of basis. So it's an interesting development where in some dimensions we seem to have moved much further ahead and are much closer to where the rest of the world is. But I think the rest of the world is actually in many ways moving faster in some countries. So this is an area where it has a relevance for inclusion, but it also has a relevance for banking at large. Now, you know, I've seen, and I'm sure that has been discussed in this conference. There's a very good paper that the Niti Aayog has brought out on digital banking, and it makes the point that, you know, we need to consider how do we go about dealing with regulation in a world which is changing so fast, where changes are driven by technology. Now, there are some obvious concerns. I mean, obviously, if you have a huge amount of financial digitalization, then the issue of security, people have to be reassured that their bank accounts, etc., cannot be hacked into, etc., etc. That's a huge problem. Also, you have the problem of financial stability, because in the new system, new fintechs have come in, which are performing quasi-lending roles. I mean, where a fintech is simply providing a platform for consumers to access the balance sheet of an existing bank, and the bank itself is regulated the way it should be, or the non-bank finance institution is regulated the way it should be, then that's not a problem. But new forms of lending support are coming in where fintechs are giving banks a little bit of assurance about the quality of the credit worthiness of the borrower. I mean, they have much more information and are much more nimble in processing this information on the borrower than the banks have. And they use this access to data to make judgments. And based on, I mean, one approach would be simply that they tell the bank that they have some algorithmic credit score, and based on that algorithmic credit score, this particular borrower scores X points. Now, that would be a very simple provision of information to the bank or the financial institution. The actual lending would be done by the bank or the financial institution to the individual or the unit concerned. But here you have a situation where they are actually willing to take on some risk. I mean, for example, offer to take on a 10% first loss credit guarantee. And then this raises concerns, legitimate concerns, I think, with the Reserve Bank. Because if the financial institution concerned takes that risk-sharing offer at face value, they have to be reassured that there's credibility behind that and that people are not simply taking on too much risk. Because if they are taking on too much risk, then that will cascade through the system in the sense that if they fail to deliver on their obligations, you will have other bankruptcies. Now, the experience we've had with non-bank finance corporations shows that while these organizations play a very major role in opening up the credit space, they can also introduce vulnerabilities, and we've had some very well-known collapses of non-bank finance institutions in India. And that naturally leads to tightening of regulation, which is the right thing to do on these institutions. So similarly here, you've got fintechs performing a kind of credit enhancement role, taking some risk on their own balance sheets, but their balance sheets are not regulated. So what should we do? You know, I think one of the problems in this is that it's very important to recognize that while regulation is important, it shouldn't be done in a wooden manner, which actually leads to killing innovation, because that's the other side of the coin. I mean, flexibility allows innovation, which allows increased productivity. Regulation limits risk, but it also reduces innovation. How that balance is struck is something which requires very careful thinking. And, you know, in my view, I mean, we have to address this issue. I think the Niti Aayog paper, which I'm sure you've all looked at, brings it out very nicely. We should be guided by much more knowledge of what other countries are doing. I mean, ultimately, India is competing with the rest of the world. And if the regulations that we are bringing in are not very different from what other countries are doing, then we're not putting ourselves at any competitive disadvantage. But if we are becoming a little too wooden and a little too rigid compared to other countries, then we are putting ourselves at a competitive disadvantage. So I'm glad that I believe at least the version of the paper I saw invited comments to be submitted by the end of December. That's pretty close to today. But I think organizations like the Inclusive Finance Summit should take a look at such papers and give their recommendations back to the government so that when the final decisions are taken, those decisions can also be said to be well informed. And I think these are some of the things that we have to look at. Looking further ahead, internationally, people have moved towards digital banks. So in effect, you you license digital banks would be banks that don't necessarily have all the kind of branches and this and that which a traditional bank needs. But they can be subjected to financial regulation, which would ensure stability. So, I mean, if you look at the cost advantages of digital banks compared to brick and mortar banking, that is clearly something that we need to promote. And in the broader context, it will actually lead to financial inclusion for the society as a whole. But you know, it will put pressure on the existing system. So I mean, if you look at the existing system consisting of the public sector banks, the private sector banks, non-bank finance companies, existing fintechs, and maybe new digital banks. I mean, the introduction of the new technology players, both fintechs and digital banks, will put a huge amount of pressure on the traditional players, especially the banks, and within the banks, on both the public sector banks and the private sector banks. Now, I think this has been a problem that many people concerned with financial development have worried about, that our public sector banks are burdened with too heavy a regulatory control, not by the Reserve Bank of India, but actually by the government, because they're public sector banks. So I think if it's a world which has now become more competitive, already the private sector banks had less regulatory control over them than public sector banks. And if you go back to 2009, when I last attended this summit, and you look at the present position, I mean, the share of credit coming from private sector banks has increased very substantially. Many people believe that this is the result of public sector banks not being able to be as nimble in adjusting to new technology, bringing in new technology, etc. You know, from the point of view of the private sector banks, actually this is quite an ideal situation because they can happily look forward to expanding their balance sheet because their major competitors are somewhat constrained. But if you're concerned about this large part of our banking system, is still about 60% or so, being more efficient, you need to consider the question of can they be given the flexibility needed on a comparable basis with the private sector banks. But now both public sector banks and private sector banks will face much greater competition from digital banks if digital banks are allowed. Because these will be much more nimble, lower cost, etc. I don't pretend to be an expert in how we should be handling the complex challenges of dealing with the regulation of these different entities. But I think what we need to keep in mind is that a healthy development of the banking system that ensures the broadest range of inclusion does mean that India's banking system should benefit from all the technological advantages that accrue from modern digital connectivity. We know that connectivity is going to increase. The government is spending a lot of energy in trying to get connectivity through to every gram panchayat, etc. The expansion of mobile telephony, within that, the expansion of smartphones, the growth of financial literacy, which is taking place a little bit slowly, but it is taking place. And more generally, the awareness of people that they can actually take control of things much more. The growth of e-commerce, which has made people much more willing to experiment with new forms of commercial interactions. I mean, all of this creates an environment in which the financial system is well positioned to change. Now, within that, it's not just the upper end of the financial system. the microfinance institutions and the fintechs, they also need to play an important role. And I don't know whether, for example, the microfinance institutions can also benefit from fintechs who have a huge amount of information on potential customers. There's one other point that I want to make, and that is that, you know, when we think about banks and banking and so on, naturally we're thinking of them as institutions that provide credit, which is of course very important. There's no doubt that our middle and small enterprises and also our micro enterprises don't actually get enough access to credit. Part of the reason is simply that the cost of servicing them is so high, which is why MFIs, NBFCs, and fintechs might play an important role in expanding credit to this group. But I think more broadly, if you think of the expansion of the digital economy and the formalization of the economy, which is unavoidable and not a bad thing either, you will see change in the way credit is disbursed across the system. I mean, some attitudes will have to change. I mean, for example, our traditional attitude is that the banks don't give consumer credit. I mean, they do give personal loans now, but the traditional attitude was that the banks do not give personal credit. They should be giving credit for productive purposes. But, you know, increasingly, if you have a younger population which is used to supporting a consumption level which would be financed by consumer credit, then, I mean, basically, that credit has to come from somewhere within the credit system. And certainly the NBFCs and even MFIs can play a role there. So I think we will be seeing a lot of change in these areas. Each of the participants in this area need to see whether they are being given a level playing field compared to others. You know, the regulator has a very tough job in this process because there are many different kinds of people that have to be regulated. And each one has a vested interest in the regulation moving in the direction which favors them compared to their competitors. So how do you get that balance is a tough task. I think there's no alternative but to have much broader discussion of the issues, much greater involvement of the industry that's actually being regulated, with a great deal of to and fro, so that rather than having decisions simply taken and announced and then listening to complaints, it's a good idea to encourage advanced consultation mechanisms where what the Reserve Bank wants to do in terms of regulation is put out in advance to begin with and elicit comments from concerned sectors. Now, in some sense, I think the Reserve Bank has moved in that direction. I mean, for example, the experiment of a regulatory sandbox is a very good one. When you have something that is new, it's better to allow limited experimentation to see how it will work rather than take a decision ex ante that this is either good or bad, or we're going to allow it or not allow it. But I think in all of this, what we need to be most aware of is that the world 10 years from today is going to be radically different from what it is today. I mean, just imagine to yourself back in 2009, you would not have been able to predict what kind of changes you're going to see in the world of finance. And there's no reason to think that it's going to be any slower moving forward. So we need very active involvement of the players, the main players in the field, the customers in the field, consumer organizations, etc. And of course, the media, which sort of provides a forum where concerned opinions can be put across and given due weightage. So it's a very exciting area, the whole area of financial services development. I must congratulate the organizers for successfully running this summit for such a long time. And I mean, I just hope that they continue to do that. And the summit and the discussions that take place in the summit will provide guidance to both the government and the regulators in how to keep the Indian financial system moving forward. So I think I've reached the end of the time that was allotted to me. So let me simply close by thanking the organizers for inviting me to make the concluding remarks in what has been, I'm sure, a very, very productive 2 days of pretty intense discussions on virtually every aspect of the subject that one can think of. So thank you all very much.
Thank you so much, sir, for capturing the evolution of financial inclusion in the country and also giving some forward-looking recommendations. And also, thank you for concluding the Inclusive Finance India Summit 2021 on such a high note. We were very glad that you agreed to speak at the summit after almost 10 years. It was a pleasure listening to you, sir. Thank you.
Thank you. Thanks very much. Thank you.
क्या है जो आता हुआ अच्छा लगता है लेकिन जाता हुआ नहीं?
एक और हिंट, ये चीज जाती है हर महीने पर आती है 3 महीने में एक बार।
ब्याज, इंटरेस्ट।
लोन पे तो इंटरेस्ट बैंक हर महीने लेते हैं,
लेकिन सेविंग्स अकाउंट में इंटरेस्ट देते हैं 3 महीने में एक बार।
ऐसा क्यों?
एयू बैंक के सेविंग्स अकाउंट में इंटरेस्ट मिलता है हर महीने,
मतलब साल में 12 बार।
एयू बैंक, बदलाव